Okay, hi, and welcome to today's webinar. I'm Ed Croft, and I'm going to be presenting this webinar all about how to conduct forensic fundamental analysis on your stocks in only about 10 minutes or so. Now, that might seem an extravagant claim, but I've dedicated most of my own working life to actually making this a reality. So this presentation, I hope, should take an hour or so, and there'll be plenty of time for Q&A afterwards. And I'm very happy to take many live requests from any of you who are on the webinar today. I hope that many of you will say hi using the chat box. You'll find it just on the side of the webinar browser window. So do let everybody know where you are and where you might be checking in from, because I know that quite a lot of you have come from Money Week. Some of you have come from our own community. So please let us know where you're from, and don't be afraid to ask a question. I will be doing a long Q&A at the end, so save up any specific questions for then. I'm very happy to try and answer questions as I go along about the material that I'm talking about. But I will do a much bigger Q&A session at the end. So generally, a little bit about me. So you might be wondering who I am. My name's Ed Page Croft. I am the co-founder and CEO of Stockopedia.com. I've been working in and around markets all my life. After university, I went into the city and I worked in private clients for ultra high net worth in Goldman Sachs. And after I spent a number of years in the city, I left and I started managing my own money, family money. And I started looking around and couldn't really see anything that would help me on this. And my curiosity got the better of me. And with a friend, an old friend, we actually set out to try and address that. And what started as a hobby project has become a business and actually led to some of the things that I will show you today. But ultimately, it's all about better results for investors. So if you're having bad sound, try refreshing it. You know, this is all going through the web, so if it may be that you have a connection issue your end, but everything is running live for us, and we've got it all tested. So next up, I'm going to be talking a lot about what I call stock reports. And this is a very condensed way of looking at fundamental and technical statistics on stocks. And I'm going to be showing you how, using a format like this, you know, don't be intimidated. I'm going to walk you right through it, about how using a format like this can rapidly reduce the risk in your investments. Now, I'm just going to go and switch to the website for a minute, because I want to show you how this all works. So bear with me 1 minute. I'm going to flick back and forth every now and then. But if I was to go and bring up stocks, for example, we have this website and this service through the browser and on your phones where you can literally bring up stock reports on any stock instantly. And one of the most popular features are these stock ranks up at the top right, which I'll explain more closely in a minute. But some very, very popular stocks that I believe private investors get blindsided by, such as Serious Minerals this week, which dropped 50% on Monday. I believe, passionately, that most private investors should learn and be able to assess very quickly that stocks like this are exceedingly risky. And I know that there were a massive amount of the private investor community have been invested in a share like this. And we make it very, very, very clear, almost instantly, the long odds of a share like this. And many of our rankings and our classifications and the other statistics, such as the red flags and so on, really help one avoid or minimize exposure to very much like lottery stocks and blue sky stocks. So I'm going to go into this a lot more later, but I'm just going to keep going through my presentation for the time being. And I will come back to that to explain more. Before I crack on, very quick disclaimer. Everybody here is a self-directed investor. We live in an era of ISAs and SIPs, and we're all quite well aware of that. Everything I'm going to show you today, we're a data provider, an education and community provider. And while we try and explain all the data and show how it's worked in the past, the future isn't guaranteed to rhyme as the past. So, obviously, if you do need personal advice, go to a financial advisor, but very happy to answer questions on a non-advisory basis. So what are we going to be looking at? I'm going to give you a quick background to these stock reports, why I think it's so important to have access to this kind of data, And then I'm going to go through 7 key areas of analysis that I think are vital to understand on a stock, and the things that I always personally look at myself. So going through the stock ranks, which are a very, very quick assessment of the key drivers of potential return. Looking at the classification system, which helps you understand the type of share you're dealing with instantly. Looking at the essential fundamental metrics of a stock against its peer group, visually and instantly. Then again, looking at the red flags, which are based on a lot of academic research, academic financiers. And then looking at screens it might have passed, digging into the financial history because it shows so many vital signs that can show you brilliant stocks and separate the wheat from the chaff. And I also want to try and educate everyone on how to understand broker figures. So this part on the sentiment trend is all about learning to read the broker recommendations and their estimates a bit more accurately. So let me have a little look. So, and then beyond that, we're going to go and look at a few stocks individually across growth and dividends and common trap stocks, a bit like Sirius Minerals. Anyways, next up, John Templeton, a great inspiration for so many investors. If you want to have better performance than the crowd, you must do things differently from the crowd. Now, I'm a real student of the crowd, and I have been for several decades. I'm in my mid-40s now, and I've been gathering a lot of research into private investors, into my own behavior, into other people's behavior. And you tend to find that private investors, on average, have a tendency to underperform the market. Now, that might not be news to anybody, but many of these studies by acclaimed academics have proven it out. But they all tend to find out that there is a smaller cohort who persistently outperform. And it's that sort of cohort which I believe that if you self-educate into some of the drivers of return, the genuine drivers of return in the stock market, that you can actually go and move yourself into. And this, I believe a lot of the problems that private investors have come from lack of process and lack of confidence due to sort of unstructured approaches. And I talk to our subscribers, and at Stockopedia, we have around 10,000 subscribers who talk to us about what their approach was like before they used this financial data and fundamentals and good fundamentals, and how it changed afterwards. I'm just going to share with you what people say about their approach before they learnt about fundamentals, etc. They talk about having an unstructured approach, mixed returns, a sort of haphazard or woolly approaches to their investing, getting their ideas from the press, from tips, from the internet, never feeling fully confident. And that's something that I'm hoping that through this hour, I can help you address, etc. Now, at the end of this hour, I'm going to give you actual access to the Stockopedia service, sort of completely free for a couple of weeks, and give you a really, really good introductory offer. So it really reduces your risk, your financial risk. I really hope you'll take a good look at it, as it's something that has, changed the lives of many. And, obviously me and my team are massively passionate about, and it's just a fantastic service. So please do stick around for it. Anyway, the little bit of background on what we're trying to achieve with the stock reports. There's a real proud lineage of one-page formats of analyzing stocks. Now, as I've been around since before the internet, I do remember some of the great print products that exist on stocks, which give a condensed view of financials and fundamentals. A couple that I loved were Company Refs and Value Line. I don't know if anyone remembers them. But the great thing about the one-page format is that density of information and the clarity of design. And that's something I've tried to really move to the web. And it really, that clarity of design creates much better investor outcomes and benefits. So as long as you have timely, accurate, and comprehensive information in a clear design, it's easy to use, and you try and load it with insightful information, you get these better outcomes of better decision-making, more confidence, more discipline, but most of all, time saved. And that's one of the key benefits is the time saved. So I'm going to go through 7 key areas of a stock report to show you exactly how this can significantly help you. And but before I do, just to give you a bit more confidence, because a lot of the data on the web is not worth relying on. And if it was, I would not have set up this service at great expense to myself and my associate investors, because most data on the web is published for free. And when data is published for free, that means that ultimately there is an advertising model behind it, and often it's not given the sort of respect that it should, and accuracy tends to be diminished. So what we do is we have a institutional quality data supplier, which is Thomson Reuters. If you might remember, Thomson and Reuters merged, and they're a sort of 30 billion plus market cap company that have now spun off their data service into a separate service called Refinitiv, which has been backed by Blackstone. But they employ thousands of analysts all around the world who scan, audit, and standardize financial data into their databases. We pull it down every day, financial statements, analyst estimates from the brokers, price quotes, histories, other company information. And it's pulled into our systems where our analysts, I've got lots of CFAs here, and developer team organize, clean it up, and we crunch about 60 million computations on this data every night. And we add all the financial ratios, all the statistics you'll see are ours at Stockopedia. And, really this is what a huge part of the service is all about: accurate, timely data. It happens absolutely every day, and is super important. So, we really kind of set out our stall on the quality of our data, and that's one of the ways that it's really differentiated. So looking at this stock report, it's dense with information, and I'm going to go and look at some of the key areas on it. So first of all, the stock ranks. I don't know if you've ever used a ranking or rating system before, but I have read hundreds of investment books, and the stock rank system is really a framework for understanding what I call the factor exposure of every stock. Factors are the key drivers of returns that the academics have proven are very correlated with stock returns. So we use some rankings on quality, value, and momentum. Now, if I zoom in a little bit on this, the quality, value, and momentum of every stock are published up here on the right. You can think of quality as being assessing the profitability, cash flow, margins of any stock, etc. The value being the relative cheapness of a stock based on pure valuation ratios. The momentum combines price and earnings momentum, and the overall stock rank is a blended version of all three. So it has all three in that one number. Now, the important thing to understand about each of these ranks is that they go from 0 to 100 as best. So they're percentile ranks, which means that if you see a stock ranked 99, it means it's ranked better than 99% of the market. If you see a stock ranked about 10, it means that it's ranked amongst the worst 10% of the market. And that's a very important thing to remember. I have one of my staff members, bless him, who built a portfolio. It was only thankfully a demo portfolio of stocks that were ranked 1, because he thought that was the best rank. No, these are percentile ranks. 100 is best. And the way that we compute these numbers is we take a whole bunch of financial ratios, such as valuation ratios, the P ratio, the price to book ratio, etc. And we put them and we rank them all individually across the market, and we build them into what we call a composite. And that composite, we re-rank, and it generates these ranks. Now, they are extremely effective, and we publish them there at the top right, but also we publish a little chart which shows the history of the ranking over time. This is one for the trainline.com, and it's only recently listed, so there's not much history there. Now, it's important to when one is using the ranks to understand that they have worked extremely well. We've been publishing them since early 2013, and we tracked the performance of portfolios of each ranking at each point in time. And the top ranked shares have significantly outperformed the market. The blue line here is the FTSE All Share. The green line is the 90 plus ranked shares. This slide's actually since April. And the lowest ranked shares here have significantly underperformed the market. And if you look at it in a bar chart, you can see 90 to 100 ranked shares on the right, 0 to 10 on the left, and the annualized return there. So my rule of thumb is simply that I don't personally buy anything under a rank of 50. In fact, it's rare that I buy a stock that's ranked under 80, because these types of shares have significantly outperformed the market over the last 6 years. The next 6 years might be different, but we also back tested these ranks way back on 20 years of data, and we found similar results. So it's a very, very it's been a very sound system for assessing stocks that may have the characteristics of winners. And I think this is looking at the hit rate of each of these buckets. And this is what is most important, because if somebody kind of goes on and looks at a 99 rank, so Kevin asking, do those charts account for trading costs? No, they don't. That chart is actually a quarterly rebalanced chart. The annually rebalanced chart has slightly worse performance. From memory, around the 13% annualized chart. But if you go onto the Stockopedia website, we have a big community section, and you can actually talk to people about how they've done. And our community results really back these things up. Some people have done far better, some people haven't done as well, but there's a range. But what I wanted to stress here is that the hit rate of picking winners. Now, this chart was put together by Ollie Cooper, who's a CFA, works with me. And Ollie analyzed on an annual basis since 2013 what I call the hit rate of picking winners. So in the blue chart, you see the blue line, the percentage of winners, and the red is the percentage of losers in each of these ranking buckets. So from about 70 plus, there's an almost 2-to-1 chance of picking a winner, and we define a winner on a 1-year basis as a stock that has gone up in a 1-year basis in terms of its capital return. So this ignores dividends, although dividends in higher ranking shares tend to be higher dividend payers. But you can see there is more than a 2-to-1 chance of picking a loser in 0 to 30 ranked shares. So this is I always like to say that the market. I think it was Ben Graham that said that in the short term, the market's a voting machine, but in the long run, it's a weighing machine. And these statistics bear out in portfolios over the longer term. So it's really worth bearing in mind. And one of the things I like to do when I'm on the site is check the rank, and it's almost like a sense check of, is this a gamble or not? And I know it's more of a gamble if it's got a low ranking. And that's really one of the best ways. It's almost like sanity checking stock tips that you hear elsewhere. So moving on, I'm happy to take more questions on this about the rankings, but there's one here. When I rank value, each company requires a different measure. Well, what we do is on the value rank is we actually take 6, and I've got lots of learning materials in the website. There's a tab, and I'll show you the website later. There's a tab called Learn. You could go in there, dig into the exact way that we calculate each of these composite metrics. So do go and dig in. We have a very blended approach that ranks value across the whole market, and it's proven very effective. And I don't actually have the sector slides here, but it's proven very robust over every sector, apart from the energy sector, where the top ranked shares have pretty much matched the market. So it's been quite robust across sector classifications, which brings me on to classifications. So this is really about understanding the type of stock. So on the stock reports, we have this segment underneath the price quote in the header, which gives you 4 different classifications. And I want to run through those because these are very, very powerful for understanding the type of share you're dealing with, but also for understanding how it might fit in with your portfolio and your expectations of it. So the sector classification, I know it's a pretty obvious thing, and most people understand sectors, but they often actually make some mistakes there. So we've got the sector classification, what I call the risk rating classification, which goes from conservative through to highly speculative. The size group, from micro cap to large cap, and what we call the style. And this style is a very powerful classification that I'm exceedingly proud of, which I'll go into in a minute. But first of all, sectors. We provide a 10-level classification based on every stock's economic sector. They're split into 3 super sectors: cyclicals, defensives, and sensitives, and 3 or 4 sectors within those super sectors. Now, many people don't realize this, but a lot of stocks are cyclical, and that means they tend to move up and down with the major macro economy a lot more kind of violently, as it were. They can, if you imagine house builders can, or financial stocks can really, really rocket in recoveries, but often in bad sort of credit environments, they can do really quite badly. Whereas defensive stocks, which you can think of, healthcare stocks like pharmaceuticals, defensive consumer stocks, etc., they tend to be a bit more resistant. They might not go up as much in a bull market, but they won't go down as much in a bear market. And then there's something in between, more sensitive sectors, which actually are sort of in between. But choosing sectors is a very, very important part of diversification. I've seen so many private investors load up on energy and mining stocks with no regard to any other sector. And, there is a significant economic cost to not diversifying your portfolio because of all the different ways that sectors work. Everyone thinks they can beat the market. Everyone thinks they're smarter than the market. But my experience shows that actually few are. And one of the best ways you can actually sort of, deal with this is by diversifying across sectors where actually there's more likely to be persistent winners. So some of the ones I'd like to look in are consumer defensives, where you find a lot of brands. Also industrials, you can find great stocks, technology, obviously great stocks, etc. But that's all in that classification. Now, this is a real innovation on Stockopedia, and it's something that I see most private investors have a tendency to completely ignore, which is the volatility of the stock. Now, we use the volatility, literally the share price volatility, to calculate a risk rating. Now, I know volatility is not risk, but volatility, the historic volatility, is one of the best measures of the likely future volatility. And also, conservative shares have a tendency to outperform highly speculative shares over the longer term. You find that private investors tend to invest in speculative, highly speculative shares because they think they can get rich quick on them. So it's like the tortoise and the hare, and we all like backing the hare. But actually, the tortoise wins in the long term. And we've done a lot of studies on this. And less risky shares have a tendency to outperform more risky shares. It's called the low volatility anomaly, but it's pretty powerful. This is the percentage annualized return since 2013 of each of these buckets. And you can see that conservative, the lowest three risk ratings, or the least volatile, have sort of done about 6.5% a year, but the speculative and highly speculative have done very, very poorly in comparison. And I think that's a really important statistic. And so something to bear in mind. And I just love the fact that you get this very, very, very quick one-word statement which says this is the type of risk of the share. Moving on, size group. Most people know sort of what small caps and mid caps are. We classify them in these buckets. I won't dwell too much on this, but pretty much large caps tends to equate to FTSE 100 type of size of share. Mid caps, more like the FTSE 250. Small caps, more like the small cap index, and micro cap being all the rest. It's not exactly mapping like that, but it's pretty much similar. And so it's a very useful, quick way of understanding that. But also we provide these size metrics at the top in the header too. So many people know what the market capitalization is, but they tend to think of that as the size of the company. It's only the market value of the equity. So it's the market, it's obviously the number of shares times the share price is the market capitalization. But many people don't understand what an enterprise value is. And a company can have a lot of debt. And if a company does have a lot of debt, the market cap won't tell you that about it. So we provide the enterprise value, which adds the net debt or debt less cash to the market cap. So in a very, very brief way, you can look at the market cap and the enterprise value, and the difference you'll know is the debt exposure. And that gives you another sense of the kind of risk of a share, and an overly indebted share can be a little bit of trouble. We have a lot more on debt and leverage later. But that's a quick sense check. So I like the fact that at the top of this, you get like lots and lots of the statistics you need to very quickly understand a share and the type of thing you're dealing with. So the next one is we call the stock rank styles. And this is something I have done an entire webinar just on the styles because I was so excited about it when we invented them. But essentially, this takes the quality, value, and momentum rank and assigns a classification based on whether each of those ranks is high or low. And there are 4 winning styles, and I'll explain these in a minute, which are labeled in green: super stocks, high flyers, turnarounds, and contrarian stocks. And 4 losing styles: value traps, momentum traps, falling stars, and what we call sucker stocks, which is the kind of stock which I'm afraid to say Sirius Minerals was actually classified on Monday before it fell, actually last week, before it fell on Monday by 50%. And I know it's actually been a classification that's got me into a little bit of trouble sometimes at conferences. But it is a very, very powerful classification. And we found it underperforms all the others. And it essentially means a stock that has very poor quality, poor value, and poor momentum. There's also a bucket which is unclassified, which is about a third of the market. Now, if I can just explain this a little bit more clearly, and I think Sam, who's listening, has these slides. I'm not sure they'll be in the same order, but he'll be willing to share them with you via the chat at some point in this webinar, because you can take this away and use it as a bit of a crib sheet. If you take get your free access to the site, you can use this as a bit of a crib sheet. But anyway, if you think about one of these little cards here, QVM, quality, value, momentum. The community on Stockopedia like to call high QVM stocks and use these sort of QV or VM phrases to describe certain types of shares. But essentially, if you look on this card, quality, value, momentum, imagine if all three are quite strong, that's what we classify as super stock. If good quality and good value, in other words, a cheap, good quality share, which has got a bad momentum or it's on a dip, you'd think of as a contrarian investment. And a lot of great investors have had that investment style. You tend to find a lot of big value investors use that investment style because it's the only way they can buy in a lot of size. High flyers, which is what I would call the growth stars of the market. Very high quality, profitable companies, very strong business and price momentum, but that price and business momentum tends to make them quite expensive. So they're the real market stars. So you find, and I'll show you some of them actually on the website shortly. The other one is turnarounds in the winning styles, which is good, very cheap, very good momentum, but poor quality. So these equate to quite regular investment. So a lot of people invest only according to one of these styles. A lot of professional investors, recovery funds tend to focus on turnarounds. But this gives you a real label right at the top of every stock, so you know exactly the kind of share you're dealing with. The four losing styles down here, Value Trap is a classic example because a lot of us always go and look for a bargain. But if you've been burned in the stock market every now and then, like I have, often it's because you've gone and tried to find something really cheap, a very cheap value share that has poor quality, poor momentum, and we call that a value trap. And similarly for momentum traps, falling stars, which are the very high quality shares that are too expensive, which have sort of broker numbers being cut. And then the sucker stock, which say no more about. But it's a really, really useful classification, and it's right there at the top of the stock report. So that's it really on those classifications. But before I move on to the next bit, I'm on second of 7 sections. But looking at the win rate, I explained the win rate earlier. But you can see the win rate of each of these buckets of categories of stock. You can see why we call these winning styles. Super stock, high flyer, turnaround, contrarian, because they have a tendency to beat the markets. The contrarians have not done as well over the last 6 years as high flyers, super stocks, and turnarounds, but much better than all the losing styles. And I was beating up on sucker stocks down there, and you can see why. Interestingly, there is a third of the market unclassified in what we call style neutral, and they have actually been done reasonably well. And if you look at a pie chart, there's about a third of the market is unclassified because they don't neatly fit into one of these buckets. So just because something doesn't have a winning style classification does not mean it can't actually be a decent performer. So there you go. But anyway, pretty useful. And I'd encourage Sam to share these slides with you later so you can really dig through them. Now, going on to sort of more traditional fundamental analysis, we have this system we call the traffic lights. I've just been through a lot of what I call our proprietary metrics at the top of the page. And this is more about sort of like how we do more standard fundamental analysis on shares. So at the top of stock reports, you will find and also further down the stock report, a set of key financial ratios, some of them being very familiar. And yes, you can find the P ratio on lots of websites. I want to explain why our P ratio is so much better, and our statistics are much better than anybody else's out there. One of the great innovations we have, I'm not going to explain all the details of some of these ratios. I'm hoping that you've probably come across yields and P ratios before. But what I will explain is how, even if you don't know the value of a P ratio, what it should be at, how what we call the traffic lights, which are here on the right, can really help you understand the relative rank of them. So I've just highlighted them here in a call out. These traffic lights allow you to visualize the relative ranking of every share's ratio against its peer group. So if you imagine a P ratio of 8 times, now that's quite cheap in the market at the moment, and we've got this meter. Excuse me, I've got to drink some water. My throat's a little bit dry. I've had a bad cough in the last couple of weeks. Getting better, but still need a bit of water. The P ratio, if it is quite cheap, these meters, which you see here, will be quite long and green. In other words, green is for good. If it's about average, it's going to be amber. And if it's quite bad or expensive or low growth or bad yield, it will be thin and red. So very, very quickly, you can see get a sort of fingerprint of how that financial ratio compares against the rest of the market. And that's a very, very, very useful innovation for investors. We actually do these traffic lights against both the industry group and against the market as a whole. So the first column is against the industry group for a stock, and the second one is against the entire market. And we have this sort of what I call factor investing underpinning to the whole site, which is that in general, the statistics will play out that cheaper stocks or faster growing stocks or higher yielding shares or better profitability shares tend to beat the market. And these sorts of statistics help you find them at a glance. So very, very useful. If you hover over them, if you hover over any of these bars, you get a pop-up like this, which actually shows you specifically what I call the ordinal rank against its sector, its industry or the market as a whole. So very, very useful. Just want to dive a little bit deeper for a moment. I won't spend too much time on this, but it's a reason why I think our forecast ratios are so much more accurate than everyone else's. When you're comparing the forecasts of a company against another company, what happens if you're using the forecast P ratio of a company that reports in March with the forecast ratio of a company that reports in December? Well, you're not comparing like with like, and that causes valuation discrepancies. So, a company, you can't really compare a company on a P of 10 with one on a P of 12 if they have different year ends. So what we do is use rolling financial ratios. So if you think about us being on a current date here, most of the way through 2019, we'll look at a 1 year ahead basis. And let's say the company reports at the end of 2020 and the brokers are forecasting 20 pence of earnings for that point in time. And for 2021, they're forecasting 30p. On a 1 year ahead basis, we would take 3/4 of next year's forecast, a quarter of this year's, and standardize it into a 1 year rolling forecast, which gives you a much, much more accurate measure of the P ratio or whatever ratio it is. So that's a very, very important thing that you don't get on any normal financial website. And it does make a huge difference when you're comparing stocks. Looking at our historic ratios, we take a similar approach. So valuation ratios often can be looked backwards. And instead of us looking at the historic ratio based on last annual report, which can be often more than sort of 13 months out of date, we use something called trailing 12-month data, which is often called TTM. Hang on a minute, just checking. Anyway, I'm just looking at some of the questions. If I look that way, it means I'm looking at some of your questions. So I'll try and have a look at some of them in a minute. But obviously, if you're looking backwards, you want to use trailing 12-month data. Now, to explain that quickly, imagine the current data is here, and in the last year, if it's a UK stock, they may have reported interim or half-year statement. And on a historic P ratio, that will now be out of date from last year's year end. And of course, many, especially the big caps in the UK and all stocks in America and many parts of region around the world, report quarterly accounts. And that means, like right now, before the year end, you may have seen 3 quarters being published. So we'll wrap all of that up into a completely current state of the company, which we'll then use to sort of calculate historic price to sales or price to earnings ratios. So both on a forecast basis and a historic basis, using rolling or TTM data, we can create the most accurate picture there is. And accuracy matters if you're trying to make money in the market from and get an edge on the market. You need every edge you can get. So very, very important to know. Now, I'm going to just have a quick look at a question. Publish. Let me have a quick look. Let me have a look. I'm going to answer that, James. I might get back to you on that. I mean, we've got a little question there about calculating accurate P ratios. We do actually calculate our P ratios in a number of ways, depending on which one it is. So we do publish a lot of different P ratios, from forecast ratios to historic ratios, and do it on a number of different bases. So, let me get back to you on it, on your specific question. There are a variety of different ways we calculate them, and there's a variety of different ways that we calculate the EPS. It's always very, very important to understand the accounting basis on which different financial ratios are calculated. And, we also are very inspired by the literature, as I'll show you in, I think, point 6 of my 7 that I'm getting through. But right now, let me look at the red flags. So this is all about saving yourself from disaster stocks with what I call time-saving algorithms from finance professors. Now, in setting up the Stockopedia site, we mined the academic literature to the nth degree. I've got a library, I haven't counted, but it's hundreds and hundreds of academic research papers. And 3 of the very, very most useful algorithms we publish on the stock report here. And because I think they are so immensely valuable for private investors, because it's so easy to get stuck in a share which has a bad bankruptcy risk, or might be cooking the books. So first up, what I call the health trend or the fundamental trend. This is from a chap called Joseph Piotrowski. He's a professor of accounting at Stanford. And he wrote this innovative paper in 2002, which was called The Use of Historical Accounting Information to Separate Winners from Losers. He knew that value stocks tended to outperform, but he wanted to find out how to avoid the basket cases in that basket of value stocks. So the ones that were going to go bust. And he used this checklist. It's a 9-point checklist that was incredibly effective. And I use it in my investing. It's about 30% of our quality rank is based on this metric. It's very predictive, and it's gives you, real clarity on whether a company's accounts are improving or deteriorating. Because 7 of the 9 checks look at last year's statements versus this year's statements. It measures across profitability and cash flow, and looks for improvements in profitability, improvements in leverage. So is the debt going down? Is liquidity getting better? Is the funding status improving? And looking at improvements in the operating efficiency. So my rule of thumb is I love seeing stocks that have a rank of 7, 8, or 9 for the F score, because it's quite a leading indicator of future financial health. The next one I have here is a bankruptcy risk indicator. This screenshot was actually taken from a financial, and we don't actually publish it for financials. But for every other 9 out of the 10 sectors, we do publish it. And this was created by a chap called Professor Edward Altman in 1972, and it's still very effective today. It's a combination of 5 weighted business ratios. They look at things like working capital, also look at the debt fields, and they bundles it all up in this fantastic metric called the Z-score. He found it to be 72% accurate in predicting bankruptcy 2 years prior to the event. So the lower the score, the greater the risk of the company falling into financial distress. And on here, for any stock, you'll see there's a little meter, which would, if it's in the distress zone, big red flag. It may not mean it goes bust, but it will mean it's got to go and raise capital and deal with its situation. It's not always 100% true. There's always an error rate in some of these things, or what I would call, false positives. But it's a very, 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 very useful measure. But this one is my favorite. It's called the Earnings Manipulation Risk Indicator, or the M score. So you can see F score, Z score, M score. Now, this is from Professor Mesud Banesh. It's just fantastic. It's a mathematical model. It uses 8 financial ratios, and it really looks for whether a company has been massaging its earnings. Banesh found that it could correctly identify 76% of manipulators, whilst only incorrectly identifying 17.5% of non-manipulators. So when this flag's high, for me, it's a massive red flag. It's probably a 3/4 chance that the company has been massaging its earnings. It's been used to indicate Enron. Students actually spotted Enron. Financial analysts failed to. And it's just such a great sense check. So these 3 are absolutely super. I'm going to move on and tell you a little bit about the screens passed. This is 5 of 7. What we do at Stockopedia, and while I'm focusing on analyzing an individual stock, we actually have a massive stock screening area on the site, which I'll show you in the Q&A section. But in this section here, which shows you very quickly whether the stock is qualifying for any of our guru screens. So we screen the market daily with the rules of 65 famous strategies across a variety of categories. Now, I've got a library of hundreds of investment books, and we've taken many of the best ones, things like Jim Slater's Zulu Principle, O'Shaughnessy's, What Works on Wall Street. We've got Greenblatt's Magic Formula, all of these fantastic books. And we screen the market. We tag all the stocks that qualify for those screens on a daily basis. And we publish it on the stock report. Now, I love this because instantly I can see whether a stock is qualifying for a few dividend screens or a few growth screens. And that's very, very helpful when you're trying to sort of get a sense check on whether other fundamentals-based investors would be looking at this stock. If there's no screens it's qualified for, often that doesn't mean it can't be a good investment, but it's just another thing to think about. And we also publish a few short screens as well. But that's very super useful and a great innovation on the site. I'm going to have a quick look at the financial summary, which gives you just fantastic information if you can learn how to read it. So aside from the obvious points, we publish this 6 years history, couple of years forecasts, and some growth rates. And we look at the obvious points from income statement, revenues, profits, etc. And as you hover over any of these lines, you get this wonderful pop-up chart. But I want to focus on some key parts of this. First of all, looking at profitability, because the one thing I like to do with my investments is check for high, stable profitability. And in this measure, you can see very quickly whether the company has some of those key information points that someone like Warren Buffett might be looking at. High operating margins, which basically shows you, the operating profit against sales. It can be an industry specific number, but high margin stocks in a specific industry are much more preferable. You don't want to see it too volatile. Volatile margins can mean, a stock can be quite buffeted by competition and so forth. Also, I like to focus on the return on capital employed and the return on equity. Focusing first on the return on capital employed, I really like seeing stocks with 12% or even 20% or higher returns on capital, because that means that a company can take investment or retain profits and reinvest it in its operations and generate those kinds of returns for their investors. So it's really the kind of the economic engine behind, or the financial engine behind a company. Whereas the return on equity is the percent profit made on every unit of equity in a stock. So these being published here actually give you an immediate sense check on the kind of the historic, consistency of these things. The one thing I would say is high returns invite competition. So it's always worth trying to check whether you believe a stock has a sustainable competitive advantage. But that's something, if I've got time, I can go into later. I do have a slide, but I don't know if I'll get time to look at it. The other thing I like to look at, which most private investors don't look at, is cash flow. So the very best investments are cash cows, and people often don't know how to look at it. They only look at the profit figure. But as I said before, earnings can be manipulated. They're very, very often manipulated with creative accounting, and companies can book profits well ahead of them actually being booked as cash, taken in as cash. And whereas cash flow is very, very hard to fudge, and there's accounting standards which now force companies to publish the cash and the cash flow in the business. Something I should have said actually earlier, because this is very related to the earnings manipulation risk and the M score, but there may be some investors in Burford Capital here, which obviously was another very, very popular stock with private investors, and we might look at. But Burford Capital had a M score that was flagged in the high risk zone before the short selling report by Muddy Waters came out. So these sorts of indicators and understanding to read about receivables and cash are very important. I like to look at a couple of things. So there's we publish the normalized earnings per share, and we look at and then from that you hope that most of it is turned into operating cash flow. The sort of difference you add back into the earnings, the non-cash items which can often be used to fudge, like depreciation, etc., back into it to actually get the genuine cash flow figures. From cash flow, you will then pay, the company will then pay for capital expenditures on plant or anything else like that. So CapEx, sometimes it can be quite consistent. You have certain types of companies, they might be investing in plant or equipment or property. And CapEx can be quite lumpy, especially in early stage companies. And, one wants to make sure that all the cash isn't eaten up by CapEx, because then you've got free cash flow. And free cash flow can be used for paying down debt, paying dividends, buying back shares. And as an equity investor, you really want to see a stock buying back shares or paying dividends. Hopefully I'll look at next in a little while, or some real cash cows, which will kind of show some of these principles in essence. Hang on a minute. There's a good question there. How can there be a stock rank of 86 if a stock only has a return on capital employed of 1%? Well, that's a very good question. I'll just quickly answer it while I'm actually was near that slide. So because we take a multi-factor approach to the overall stock rank, a stock can get a high rank even when its quality might be a little bit lower than you might want, because remember, if you look at those classifications I was talking about, often you might see a turnaround stock that has very good momentum. So the brokers are forecasting a fantastic future and the price is recovering. And it also might be very, very cheap. But some of the quality metrics might not have caught up with reality. And that can lead to having a higher stock rank, even though one of those factors is not as good as you might like. So, it all depends on one's preference, one's personal preference and psychology of investing. Because I know some people who've only ever invested in turnaround shares and do exceptionally well, because value and momentum on their own are such powerful factors. Getting back to my presentation, assessing the dividend history. If you're a dividend investor, you obviously want to know there's been a consistently growing dividend with hopefully no declines and no pauses in the growth rate over the last 5 years. A lot of companies have a policy of perpetual raises in dividends, and it very much can be a management policy. It actually inspires a lot of discipline on management, because even in declines, in bad markets, in recessions, they commit to a progressive dividend policy, and that can be very, very good for investors. This one I've highlighted here below. You can see that there was a strong dividend growth and then a pause for 3 years, and then it started growing again. Now, that's not a dividend cut, but pauses in dividends can be a little bit depressing for investors who might be really relying on it. So I like to sort of look at if I'm buying stock for income, I like to look at the dividend history and try and ensure there's no cuts. Now, if you're a dividend investor, all those quality metrics, those red flags, I would be looking at those. I'd be trying to make sure I had a high F score, a good quality rank. I want to see a good yield, but also I want to see that persistent trend of growth, because good growth in dividends, it's fantastic for the long term, and you tend to find dividend investors are long-term investors. We also show the cover, dividend cover. Another key metric for investors. I like to see it above 2. For this stock, it has been above 2 for every year. Dividend cover is literally you compare the total net earnings or net profits against the dividend payments, and that's your cover. So 2.7 times means that the dividend payments 2.7 times covered by earnings, and whereas a cover of only about 1 time means that potentially the company may have a bit more trouble paying that dividend. If it's below 1, it's probably having to eat into its cash reserves to pay you as an investor. So I think that's a very, very important thing to look at. One thing I must say is beware dilutive stocks. This is something, and I will show you before. I'm going to come back to my slides because I do want to. I know I'm picking on. Hang on a minute. Picking a little bit on Serious Minerals today. But if I go and show you, and we scroll down, you can see, these, obviously it's investing for the future. It's got very, very, very poor financials, poor cash flow, et cetera, et cetera. But one of the things I always like to look at is this diluted weighted average shares that are an issue. And these great little pop-up charts let you see that this company has been diluting investors to the tune, to an enormous amount every year. It's issuing more and more and more and more and more shares. Now, yes, this is a jam tomorrow stock. You would expect it, but the very, very best companies, I'll pick up, a company like Next PLC, which actually, if you go down and you look at its diluted weighted average shares, they're declining. And that's a very powerful lever for a shareholder of a company, because it means that the company is buying back shares. So they're using their very, very strong cash flows, which you can see here, the sort of the operating cash flow is very similar or even above the sort of EPS every year. And that means they've got lots of cash, they can pay a good dividend, they can buy back the shares. Now, you as an investor are very interested in share buybacks because, you think about earnings per share. That's the amount of earnings there are divided by the number of shares. If the number of shares is lower, it means that the earnings per share is going up. So your kind of earnings per share as an investor, if there are less shares in issue, it's a good thing. So I just think that's a really important point, something I always like to look at when I'm analyzing a stock. And many people don't, and they might not have the data to do it. And I think these things are always so important, because one of the best, it's very much the future rhymes with the past. And if a company is very dilutive and issues shares regularly, it's probably going to happen in the future. And you know how private investors get upset about not being part of placings and so on in the city. It can be a real problem. So the 7th thing I like to look at on a stock report is what I call the sentiment trend, which is about predicting the direction of travel of the stock by analyzing the trend in the analyst forecast or the broker forecast. Now, if you're like any other private investor, you often take a note of, do the brokers say it's a buy? Now, first of all, most brokers say stocks are buys. In fact, it's only a very small minority which brokers actually say are sells. So just because a broker says it's a buy, they probably say all the other stocks are a buy. But anyway, and you sort of, we've got this data on our stock report, which shows you, yes, the consensus of the broker community from strong sell to strong buy, but it does it in quite an innovative way I'll get onto in a minute. We also show the profits for next year and the year after, price target, long-term growth rate, but also the 1 month and 3 month change. And excuse me while I cough. But the change in forecast is far more valuable than the actual absolute nature of the forecast. If you look at the EPS, we've got it charted here, and I'm going to show you in a little bit more depth both of these little charts. So firstly, analyst consensus. The dark black arrow shows the current consensus recommendation. The grey arrow, I hope you can see the difference in tone there. The grey shows the consensus 3 months ago. So you can see for this stock, the arrow is going down, which means they're becoming a bit colder on it. But I believe it's best to ignore the absolute value of a recommendation, but to focus on the change in recommendation and the change in estimates, the change in forecast too. Why? Well, because it's more predictive. It's the change which is more of a leading indicator than the absolute value. Markets are quite efficient, and we've done a bit of a study on the 3-year performance of recommendations, and we found that the strongest buys in the market have a tendency to actually do worse than outperforms, holds, and sells. So, if a stock is marked to sell, it probably means that is in the price already. Whereas if a stock is a buy, it probably means too many people own it, and that's some quite valuable information to know. It doesn't mean I wouldn't buy a share that's rated a buy, but it does mean that I will be a little bit more discerning. This little chart underneath, I think, is even more valuable. It's called the earnings forecast trend, and this shows you for the blue line for this year's earnings and the light blue line for next year's earnings, how the analysts have been changing their recommendation month in, month out over the last sort of 18 months. And that's really powerful because there's been lots of research into stocks that actually have been revising earnings upwards. And a study from McKnight and Todd examined like all European stocks and found that the 20% of stocks with the highest upgrades or earnings revisions outperform the lowest 20% by over 16% a year. So I like to say up and to the right. If the trend is up and to the right, I will be really interested as a buyer. Whereas if it's in the other direction, I will be really, really reluctant because what happens is you'll get one great analyst who's got a great relationship with the management, might have more relationships with people in the supply chain or whatever, who has the best sense of where a stock's going. And he might put his analysts up, his estimate of profits up first. And then the other analysts will gradually ratchet up as they gather the information. And that leads to these trends in forecasts. So it's super valuable. And I absolutely love that. So that's really the sort of the 7 things I most like to look at. I'll come back to my presentation in a minute. But let me just go and flick to the site and just show you around for a few stocks. Let me have a little look. Someone's asking here for yeah, EPS is a nonsense measure. Yes, I agree, James. It really is. Do we analyze unit trusts and OICs? We are planning on actually analyzing unit trusts as soon as we can. It's something we do have them listed for their prices for people's portfolios, and we will be adding fund and trust data in due course. So anyway, let me have a little look at a couple of stocks. So one that's been very, very popular recently, and I've had a few requests on, it was Games Workshop. Now this is, I just want to give you a kind of live run through of the statistics on this, because this is a share that for the subscriber community, I don't know if you know Games Workshop, but they do, they're well known for doing all these kind of Warhammer and painted figurines, and there's a sort of real cult of Games Workshop sort of acolytes who absolutely love it. But they've sort of gone more digital lately, and it's led to this massive rise in the share price. We were very, very early onto Games Workshop. It was ranked 99 way back. I think first ranked in the 90s back in 2015. Sort of trod water for a while. But then, and it was ranked 100 in 2016. And from 2017 up 2018, it tripled or more, and it's just kept trucking. And as you can see here, I'm looking at the chart. This chart underneath shows you the stock rank. And you can see it's got a green band and a pink band, and it gradually declined. It's now at about a rank of 85, 84 actually today. So quality, value, momentum, as I was saying, high quality, high momentum, but quite expensive now, which makes it a high flyer, adventurous mid-cap high flyer. So the risk is not conservative, it's sort of more moderate or medium, and it's got this, still got a lot of good things going for it. But, I would not expect the future to be like the past. I wouldn't expect the future returns to be the same. One of the things that is really useful is if you click the print button, you can actually scroll back, and actually if you click any of these dates, it brings up the stock report on that date, so you can look at what the measures were like back in time as well. So again, you can see here its rank against the market for its P ratio. I can see it's qualifying for one screen, a Buffett-esque screen, very, very high profitability metrics. No red flags. It's got a good health trend, no bankruptcy risk at all, no earnings manipulation risk. So it's a this has been a pretty safe stock, although on a bit of a punchy valuation. You can see here its earnings per share against its cash flow. really generating lots of cash. Not, some of it taken up by capital expenditure. It does have and it's got a bit more of a capex hike in the last couple of years, but quite a bit of free cash flow used to pay its dividends, et cetera, et cetera. As I was saying, the weighted average number of shares has been pretty steady. No buybacks, it doesn't look like. Possibly a little bit of dilution due to management incentives. There was a dividend cut there in 2016. You can see at a glance, something to be concerned about possibly as a dividend investor, but pretty good growth more recently. And then you've got these high returns on capital, high returns on equity, and high and recently very high margins and so on. You might think that invites competition, but it's a real niche player, and working in niche markets. And here you can see the analyst consensus: strong buy, but regularly hiked earnings estimates. In the last 12 months, it's gone from a profit forecast of 150 up to 218. So that's an almost like 30% hike in forecast. And it does seem like the brokers are behind reality. So that's just some of the things I like to look at on a stock, when I'm flying over it. And literally, as I said, even less than 10 minutes, you can grasp all of this quite quickly. So I also like to look at relative strength. It's part of the momentum. And these figures really tell you on a more technical level whether the stock's beating the market on a 1-year basis, 6-month basis, and so forth. I like looking at price momentum. I think it's quite important. A lot of people can't stand the idea of momentum, but it is the most predictive measure of all. So that's just a quick whiz over Games Workshop. I'm very happy to take 1 or 2 requests. So if anyone has anything they want to talk about, but I'm going to have a little look at what else shall I have a look at? I want to have a look at possibly something like Sirius. We have been looking at Sirius Minerals, so I'll bring it up again. And we had 1 or 2 requests for it in our survey. And it's something I would call as a trap stock. And again, over the last 5 years, in fact, in all the data that we have on it, started with a low ranking, sort of got middle-ish but very low quartile. And then it's been dancing around at a rank of, sort of less than 20 very, very regularly. And that was probably at its worst ranking in the last week. And when it got to a stock rank of 8. And as it's now fallen 50%, the rank actually has gone up a bit. It's gone from 8 up to 25. Why? Because it's got so much cheaper. But they're having financing problems, etc. But instantly, I'm looking at this and I'm seeing speculative small cap value trap. This was a speculative small cap sucker stock last week, but it's now a value trap, which means that it's very, very cheap, but it might be cheap for a reason. As you can see in the fingerprint of the ranks, it's ranked with very cheap, good values, cheap, but quality is very poor, momentum is very poor. So it's only got one good factor going for it. And eyeballing the market cap against the enterprise value, well, I can see instantly there's 170 million of debt. They're going to have to pay for that debt. And if they don't have earnings and they've got to keep refinancing debt, that's tough. We can see here very quickly against book value, it's very cheap. It's trading at like 0.3 times book value. So it is a value play, but, we all know it's got some financing issues. Health trend is poor. Bankruptcy risk, it's in the distress zone. You don't know I don't know what's going to happen next. I'm not a very qualitative investor, but this sea of red in the financial summary just shows you this sort of consistently burning through, its cash. I mean, it does have a lot of cash in the books there, 350 million. I don't know what it's burning every year, but I don't know how long that's going to, will last it. But I think very, very quickly, and also you can see here, doesn't qualify for any screens. The brokers are outrageously positive on the shares. They believe it's worth sort of like 6 times as much. And that's one of the reasons so many private investors have bought into it. And you've got this very, very volatile earnings forecast for the stock. And it's being cut. Its consensus has been cut back to only buy. Now, of course, if you don't know what a share is about, you can go and read up on it. We've got this great profile section, which I find particularly useful too. Lots and lots of news and so on. Hang on a minute, and I'm going to come and look at some of your requests. So I probably do one more stock. I'm sure that lots of you have got lots to get on with. But some of the cool things that we have on the site, you can look at a share and you can compare it with others. So something I always like to do is look at an American share like Tesla, and which actually often in the past, it's been a bit of a beat up. We've beaten up on this share a lot as well. As you can see, it's had a low ranking because it's just been so expensive. It's such a glamour share. But if you look in our tools, you can go and create a comparison. And this allows you to sort of compare it against other companies. So if I was to look at it against Ford, I know, Ford is not a particularly glamorous share, but let's have a look at Ford and possibly look at General Motors too. And very quickly, you can look at it and look at all its key statistics, right up against it. So stock rank 24, these ones have much higher ranks. And as you go down the page, we highlight which statistic is best for that company with this green box. So you can see Tesla is, real glamour stocks, got the highest market cap of each of these companies. It's bigger. But for so many of its stocks, it's actually worse. For so many of its financial metrics, it's worse. It's less geared, but there's not that much going for it. So anyway, just one of the things I quite like to do, and it's super useful that this comparison page. So another thing I also like to look at is the company accounts. We have some really, really nice, if you want to go even deeper into company accounts data, you can go and click through, dig into the balance sheet data. You'll be able to see whether the auditors think that the accounts are good. I won't spend much time on that, but we don't only publish the stock reports. We've got all the news and announcements on the site. There can be discussions, but you can save these into watch lists, portfolios. You can set alerts based on fundamental data like the stock rank. So, for example, if I wanted to know when the stock rank of Tesla was greater than, let's say, 50, because I might consider it, then I can save that as an alert. And get more info on it. You can store your notes on it, and you can go and add it into your list. So, for example, I'll just go and add it into that portfolio and have a look. So you can go and analyze stocks as collectively here in a portfolio system. That's very, very useful. I won't go into that now, but one of the things I did want to show you. Okay, I'm going to actually go to some requests now, but Saga. Someone has asked for. So if I was to load Saga and look at the stock report of Saga, well, here we go. It's a financials speculative mid-cap value trap. That means instantly I know it's cheap. As you can see, very similarly to the other value trap we were looking at, it's got very, very cheap financial ratios. Now, it might well do very well. Because we classify it as a value trap doesn't necessarily mean it can't be a winner. As I said in my slides, for a stock rank of about 38 and with a value trap, the odds are probably a bit better than 2-1 against on a 1-year basis. But that's how I like to do my investing. I like to know that I've got a tailwind behind my investments. I'm not going into a headwind. So Saga, it's got a rank of 38, very poor momentum. You've seen, I'm not sure what happened there, but there's probably a bad profit warning. And good. So quality is quite low at the moment. So you can see here instantly, it's sort of obviously been losing money. Return on capital is pretty bad. And actually, if we go and look at the return on capital employed, it suddenly dips. I guess the question here is, if you're a kind of turnaround investor, would you be like, are you looking at this and thinking, I think this can get back to its historic return on capital? Or not. And I'm not going to be the judge of that right now. Certainly there's some historical precedent for that, but I'd want to kind of dig into more of an understanding if I was going to make a personal investment. It's got a fair amount of debt. Brokers are cutting the numbers. You see, I was saying I like this to be down and up and to the right. This is down and to the right, opposite to Games Workshop. So I would personally, when I look at a chart like this, I would be thinking and being a bit worried that the brokers might cut their numbers further in future because trends tend to persist. I actually once went and visited Saga right down there in Kent, so you can see that on the map. If anyone's got, so anyway, look, someone's asking me, any plans for a Stockopedia Lite, cheap or even free? Look, I'm going to, in just a minute, I'm going to show you how you can get quite deeply discounted access, and I'll make an offer for you because a lot of you are coming here for the first time and you're probably worried about the price. You might not have seen all the value, and I'd like to make sure that you can come in at a more kind of moderate rate to begin with. So I'll come back to my slides in just a minute. I just wanted to show you something I really like on the site. because we're not only about stock reports. We do have a fantastic discussion area where I write blogs, the community writes. We have a range of bloggers, Paul Scott and Graham Neary, who write about small caps every day. We have a good little editorial staff and many contributors. So it's not just stocks and stock reports. We provide the portfolios, a really, really super powerful screener, which I think is fantastic. And literally, it's so easy to go in and just start finding high yielding shares. So if I was going to go and find high yielding shares, I'd search for yield, add it into the stock screen, look for a yield. Let's go and look for yields of 4% or more, because that's a lot more than you find in from a bank. And then I might go and add, because I want to be really quick, I'm going to look for a high quality rank. Okay, stock rank, quality rank, add it. And I want to look for, I don't know, high yielders at a rank of 90 plus. And I've got 50 stocks right there. I might want to go and look for dividend cover. And I can either use search, or I can go and look down in these categories. So dividends, and I'm going to have a little bit of look, safety, dividend cover, add it. And I was saying dividend cover of more than 2, let's say. And that's immediately, there's 13 stocks there, which, might be worthy of, further interest. You can relax some of these rules as you wish, and you get these live results, and you can save your stock screen. And, I could call this quality income, and I'll have that list perpetually in my sidebar here, which is really useful. If you don't know financial data so well, in browse section, you'll find all these pre-rolled screens. I talked all about the guru screens, but you can go and use this sidebar here, scroll down, click income investing, and you'll find lots of great dividend screens that are pre-rolled. Some of them are done, and you can see the performance since inception. So this one's done particularly well. We modeled it on a book, and this is just the capital return, but it's like 200% since inception in 2002. And you can see all the candidates underneath. And so anyway, some of the kind of really powerful tools that we've got available. I'm going to go back to my presentation. Thank you very much, Neil, who's an internet business data scientist. I'm very impressed by what you've developed and the clear way you've gone through it with us. Thank you so much. It's really nice to get a compliment. So let me just go back to my slides, and I just want to sort of share with you a couple of things. I hope I've sort of, I know, like, I obviously, I'm the founder. I'm very passionate about all of this, but ultimately it's about results. We do a lot of surveys on the community, to the community, and I know surveys can sometimes, be misleading, because it depends on, anyway, but our subscribers, who are all a bit over optimistic possibly about their own results, we poll them all the time, and we find that they, in general, the majority match or outperform the market. And a certain cohort significantly outperform the market. And, that's partly because a lot of our community have learned to more, in a more structured and disciplined way, avoid those kinds of trap stocks, those kind of losing styles and losing categories of shares. I always like to say it's nothing wrong with having your gamble stocks, your lottery payoffs in your portfolio, which might pull off. But you don't want all your portfolio to look like that, because the more stocks you have in your portfolio, the more likely it is you're going to get the average return for those kinds of shares. So the one good thing is it helps that sanity check on what kind of share you're looking at, and helps you have a tailwind behind you. But I'm more proud of this and the added confidence that people get using the site. About 3 in 4 say they feel more confident in understanding the stock market since using the site. And I hope I've got that across about how I hope that would help you too. We've had lots of awards, etc., to really good ratings, lots of public reviews. I know some of these guys personally, Robbie Burns, David Stevenson, and I believe that we may be featured in Robbie's upcoming book. But they use it themselves, and lots of very, very powerful stock market investors do use the service. So you're in good company if you do come on and have a look. Anyway, I wanted to just to sort of reiterate that slide I showed you earlier about those subscribers after they come and join us, we get the same themes. Your decision making becomes more grounded in data, and often financial results are significantly better because of that rigor, that added discipline that you can add to your investing if you do invest in this kind of more structured fashion. I'm not going to tell you how to invest. You can use the tools at your own sort of discretion, but I believe that fundamentally it's a very, very powerful set of tools. I hope that you will get those results too. So anyway, getting started. The platform only starts at about £25 a month. It's about 225 for a year. We have I hope it would save you lots and lots of time. My team it's actually more than 25. There's actually about 30 of us involved now. I have a team in India. Got a team here. There's about 17 of us in Oxford, and 8 in India, and a few people remote as well. My support staff are all either CFAs in training or CFAs, and who all work on the product too. So everybody is part of the product team, the analysis team, who answer support queries. And just to be clear, if you do have a query, hang on a minute, I'll come back to some of these questions as well. If you do have a query, just go onto the site, and let me show you how you do this. Because I think last year I answered personally 20% of support tickets, because I just fundamentally believe that you don't just want support being listened to by support staff. You need to have support listened to by people that can genuinely act on it. So if I was to have a question here, I'd be, you just click that green button in the bottom right. It's a little bit obscured by my face, I'm afraid, but there is a little chat box down here on the right. And if I go, hi there, anyone home? Maybe no one's actually watching right now, but you would get a response quite quickly there. As it says, under an hour to get your response. Often it'll be me or others. So it's a really quick way of getting queries. We can't give investment advice, as I said, but we can answer queries on data, et cetera, et cetera. So anyway, it's a simple methodology, standardized research process, easy to use website, lots and lots of learning videos and guides. And that's something I wanted to stress actually. But if you go, there is actually a tab on the website that says learn. If I show you again, sorry, I'm switching, not very easy switching back and forth to the product. But if you go into the learn area, we have all these guides, and often there's lots of videos in there in which you can actually go and delve even deeper. So, I think I've got, oh look, Sonia's just replied, hello Ed. Sonia works in the Oxford office. She's CFA level 2. So she's absolutely brilliant. And anyway, she's responded. So it shows you how that pops up. I try and do as many videos as I can, but there's lots and lots of articles. So if you want to learn more about stock reports, you can go in here, read lots, dig into the articles, get more help, et cetera, and find video help in there. So I think, you can learn in your own time, in your own space, and, invest a lot of time in that. And so if you are interested, I hope that Sam will share a link to this. If you are interested, we provided this 2-week free trial, and there's absolutely no payment taken up front, so you can cancel at any time in the trial. So there's no risk at all. And there's a 25% introductory discount on any annual plan. I didn't stress actually that we do. So the UK first year would come down to about £169. But you can subscribe monthly if you want to just sort of try it for a little while at less cost. But we'll honour that offer, and keep that URL handy /analyze. Sam, if you are there, do share it. Thanks, Neil. I really appreciate the kind words. Okay, James, I'll answer a couple more questions. I'm happy to stay on for a little while if anyone does have questions. So I know there's about 100 of you on here, but if you do have questions, just ask them and I'll share what I can. So anyway, this URL does give you the offer. It has the offer code actually pushed right through onto the page from there, onto the checkout. So, I would encourage you to take it because it is the best, the best sort of way to get to know the product at a lower sort of fee. And I hope that over, the first year of using it, I have absolutely no doubt you will learn, like all the other subscribers we have, that it's something that's quite indispensable. Now, the really great thing, and I want to show you this actually, is we've just started something that I call the What's New area. So this is not something that has been built by an outsourced team. This is something that is built by my team, handpicked, and we are building new features all the time. So we've literally, in this What's New section, you'll find 3 blogs here. I published the first one, and it's all about our new mobile access. So the mobile access is really great. You can get the site on your phone, you can add it to your home screen, and the site works really nicely on a phone. But in this What's New section, you can actually see we publish quite regularly what the updates are. So every couple of weeks, we're releasing a batch of new improvements to the site. It's a work in progress. You'll see it consistently improve over the next year. We've got a fantastic roadmap, and you can learn about our roadmap actually here in the Learn section in the product roadmap area. Which will take you to actually a hosted site, which shows you some of the things that are coming. So they're working on some portfolio improvements at the moment. Then we're going to do some more work on the discussion area, directors deals, and then in the backlog, more stuff, chart signals, major institutional ownership, valuation calculators, lots of great things in there, some things under consideration, and you can see anything that's sort of recently shipped. So we try and be really transparent about what's going on. And of course, in the discussion area, there's just, you can talk to the community. We have a really, really engaged community. This shows you any of the blogs that have been posted. I'm not sure what this one is. And then you get these answers from like really engaged members of the community. Nick Ray's a very active community member. And so, don't be afraid. The community are really supportive of each other. They'll answer questions too. Well, we've got the green button. We answer there. The community are so supportive of each other. And you find this fantastically engaged community who are all subscribers. So this is not like those communities out there which are really, really noisy. But anyway, like on other sites, it's a subscriber-only community. And every day, here's a small cap report with 37 comments on it. And it comes out every day. And you can sort by best comments and, find out what are all those engaged investors looking at. In the market every day. So I think that's really, really useful. Murari, do we have any big fund managers who subscribe? We are for private investors. So we're licensed. Our data licensing is only for private investors. I can't comment on whether big fund managers do. We had Charles Stanley call me in with a huge interest in taking 200 subscriptions. So they really, really want to use the product for their wealth managers. And we're in negotiations with our data supplier to actually provide a B2B license for professional investors, because, we do get these inbound requests and we want to facilitate it. But at the moment, it's private investors only. Thanks a lot, guys. Any questions that you have? There's a question here. Do we have any qualitative data like length of service of senior execs? Look, I'll show you Burford Capital. It's a good one to pick up on. Your question's about Burford. What you can do. So one of the things if you scroll down, at the moment it's not actually showing the length of service of these directors, but we have hooked the directors up to Google. So if you click it, it will bring up a quick Google about that company executive. So, if you did, actually, it's not showing the finance officer. I presume because they've just been through another one. Chief investment officer is there, but you can use this. It's very nice and usable. You can go very, very quickly, click it, and you can see here's chief accounting officer Charles Utley. And they announced him last year. But certainly that can help. What we're hoping to do is add more ways that the community can add their own qualitative insights, because we do have this fantastic community of really engaged, very smart investors, and I want to try and find ways to tap their qualitative knowledge on things like competitive advantage, on things like the moat, on things like any of these sort of, if something's family owned, I'd like to be able to sort of tag these stocks. But at the moment, we're not doing so much of that. But obviously, the community is there who, and actually, if you look in the discussions area, we had a fantastic thread on. In fact, we've got quite a few threads on Burford Capital. Here's one with 44 comments on the next BlackRock or another Woodford value trap that's written by one of my staff, Jack. Which is very interesting. There was another thread about how it was an exception to the stock rank rules. I'm not sure where that one is here. 407 comments on this. It's gone rather quiet more recently, but because I think it's no longer an exception to the stock rank rules. But actually looking at Burford, there's quite a lot of, I know there's a lot of interest in Burford. Oh, and actually before I do that, let me just show you on all the blogs, and I love this little feature. You've got a blog about Burford, and right here in the sidebar, you've got this little snippet, a lovely little card view of all the fundamentals, the P ratio, the yield, the key stock ranks, a little chart, and you can read the profile information and just everything you need to know to get that quick analysis on the stock. But anyway, why don't we launch shares in my company in Stockopedia? I mean, the company's doing well. We get a lot of interest. We considered crowdfunding. We do have a private shareholder base. We've done some funding rounds by EIS. We might well do a crowdfund. We might well do an IPO at some stage. I don't know, but let's see what the future holds. But I'm a very, you probably tell I'm really into this. I love the business. I think my enthusiasm rubs off on all the staff, and really proud of what we're doing. Okay, thanks very much. Any other questions? Let me know. I'm really, there's still 75 of you on here. If you do want more, me to go over anything else, I'm very, very happy to. Because I booked out the rest of, another half an hour. We've been on for an hour and a half. Let me just go back to my slides and see if there's anything else that I didn't cover that might be quite useful. Remember, do go to that page /analyze to take your trial. It's really worth it. Some of the things that, I was asked about qualitative factors. Not had enough time to go into this, but, one of the things I'm often asked is, how do you know a company's got because the financials are quite good, how do you know if it's got a competitive advantage? And I like to always look at a company and look across 5 factors. You've got to think, does it have any good intangible assets? Like, does it have a good brand? Does it have any patents that protect it? Does it have any regulatory approvals? Are there any switching costs? You find like banks or software products often have a really good customer lock-in, which can actually give it some quite good competitive advantage. Network effects are a very specific type of switching cost. You can think of like Facebook or Visa or Amex. They've got great network effects, and that, it's very hard to compete with Facebook in social networking. But even something like Microsoft has a network effect because it's got like a type of file .docx that everyone has to open. Cost advantages, again, are a really great type of enduring competitive advantage. A mine in a great location or a waste management company in a great locations can be very hard to actually compete with, and can give it like actually really good profitability over time. People often don't look at boring companies. They like the glamour stocks. And I mean, like even Sirius Minerals, it does have a great location. The problems are, and I imagine the best time to invest in Sirius is probably when it's getting ready to produce. But, while things are in that, that sort of pre-stage, it's very, very difficult. And obviously greater scale or niche markets can be very powerful too. So those are some of the things I like to look at. Do we provide a level 2 data feed? Well, actually, that's really, really interesting, Richard. Not at the moment, but I've actually just in the last 2 days done a survey to subscribers to do a feasibility study of whether we should add real-time prices and level 2 data. At the moment, we don't. Our prices are all delayed. So if I actually show you, if I go to it, if I show you, for example, Burford Capital, you'll see that actually our prices are delayed. This one's about half an hour old, 2:02. It should update shortly because most people are getting their real-time prices from their brokerage. But we do have enough demand to make it commercially feasible to add in level 1 price real-time and level 2 real-time. It would come at an added cost because, you do pay fixed cost to the London Stock Exchange on a per subscriber basis for that data. And it is, and it also that would probably come to, we'd have to add it on at about 20 quid or more per subscriber. I haven't done the numbers, but I would imagine it's something that we will do at some point because a lot of people do ask for it. Looking at the next question. Elise, you've asked to receive a link to the recording of this webinar. I know there's so much info to absorb. it will come to you after the webinar. We have recorded it and it will be on YouTube, and we will distribute the slides of the webinar too. There may be some more notes at the end that you can use at your own, look at your own leisure. So you can go through it with the slides and take a trial and really, really think about it. Absolutely. Robert, I'm glad you were watching it in your garden. Can you borrow money when I'm a billionaire? Okay, lots of good feedback. So if none of you got any more questions, look, I'll tell you what I'll do very quickly before I stop. I'm going to run you through some of the best screens on the site and show you some of the ways that I like to use the site. I know I've focused on stock analysis, but I want to just show you a couple of things. So we have this really nice Today page, which is the first tab on the left, which gives you quick access to featured content. So you'll find things like our small cap report there. Here's some things by our editorial staff, a couple by Jack, one by Roland. Scrolling down, you get a quick oversight of the market. And these are some of the major indices. And it shows you the price earnings ratio of the index, the yield of the index, sort of on average. Actually, these are on a median basis, actually, and the advances and decliners. And you can click through and quickly see the index if you want by doing that. There's lots of useful links. There's news on your portfolio. So if you set up your portfolios, you get your news right here on the home page. And you can sort of scroll down and see there's been lots of sort of bits and pieces, but you can see trading updates from Tungsten, interim results, and so on. And a quick snapshot of portfolios here, as well as anything that's been upgraded or downgraded in our ranking system, and quick links to go and look at the performance history of the stock ranks over time. But in the browse section, I find it really, really useful. You can go and click to browse the major indices, so FTSE 100 and so forth. But you can also browse sectors, sort of those 10 sectors I was talking about earlier. So if you're interested in consumer defensives, you can go click through, go to consumer defensives, and just literally sort it by stock rank and find the highest ranked shares, tobacco share right at the top, and then some others. So, it's a very, very quick way of going and finding sort of good shares in specific sectors. But also there's our Stockopedia screens and the Guru screens. So looking at top ranked shares, I'll click in to see top stock ranks. And these are different, I was saying earlier about QVM, quality, value, momentum. You can see here the value momentum rank, the momentum rank, and the top stock ranks here. So clicking the top stock ranks, you can see again the performance history of those rank. That's actually a portfolio of the top 25 top stock rank shares. And you can see some of the rules in which we created this performance history. And then you can see underneath the very top ranked shares in the market. And that allows you to go off and you can look at the market cap, and you can go and dig into some of these shares. I mean, there's a house builder, red row. I mean, house builders are cyclical. And when you click through, you get to the stock report. It's got a super stock classification. It's sort of a moderately conservative share at the moment, but it is a cyclical. Cyclicals do have certain sort of macroeconomy risks, as I was saying, but very high ranking. I sort of love browsing these lists because it's just such a great way to find shares you might otherwise never look at. And that's super powerful. Also, we provide quick ways to go and browse the risk ratings. So if you wanted to find conservative shares, you can go in there, click through, but also all the Guru screens. So I particularly like some of these growth investing screens. My favorite screen of all was the Jim Slater Zulu Principle screen. Jim died a few years ago, and I had the privilege of meeting him once or twice. And he was a real inspiration for everything we've done at Stockopedia. If you haven't read his book, all these Guru screens, they do tell you all about the Guru. I'm not sure why we haven't got the book link listed there, but it should be. If we haven't, we will add it. Actually, I think if you click the Guru's name, it takes you through to Amazon. But some of these books are fantastic and should really be on every investor's library. And this strategy, as you've seen, has done fantastically well over time. There's only ever about sort of 10 to 15 shares that qualify in this strategy, but it's such a good way of finding, really, really good stocks, good small caps in this strategy. I don't know what Gately Holdings does, but these pop-ups will show you what it does. Commercial legal services. So anyway, pretty powerful stuff. I'm going to pretty much check your last questions. Andrew. Okay, if I missed your earlier question, you said, have we contemplated running our own fund? I mean, it's a really great question. If I go through to the Learn section, stock ranks and ratings, and look at the stock rank performance history, you can see these buckets of shares for the overall stock rank on different basis. But the overall stock ranks have done really, really well. I mean, even if I look at stocks of over 350 million in market cap, you can see that even that bucket of shares of like mid and large caps has returned almost 100%, versus the FTSE All Share in the same time period has only returned 21%. So we've been approached by ETF providers to launch ETFs. We've only decided not to do it at this stage because we want to focus on the subscription business and the data. But we are considering at some point launching ETFs based on the stock ranks. It's a natural progression for the business. But again, as a small business, you don't want to chase too many rabbits because you might catch neither, as it were. And really, really trying to focus on this part of the business at the moment. But I personally, I'd love to have a stock rank fund for the UK, for international stocks as well. And one key point I haven't really dwelled on is that we do have a range of subscription packages across multiple regions. So, we have Australian subscribers, we have Indian subscribers, and you get kind of, interesting results all around the world, different regions. You can sort of, browse how the ranks have done, etc. Will we be launching an app? Well, listen, that's a good question. So let me just do something a bit canny here, and I hope this works. If I inspect this, I should be able to look at this as a phone. I hope you can see this. I know you can probably see some code on the right, but this is basically what the site would look like on a phone. This is actually looking at if I look at this on an iPhone X, it would look like this. So, you get your Today page where you can sort of jump off and go and look at, you can go and browse the blogs. You can go into your portfolios, check any portfolio that you might have. You can go into the discussion section, go and look at any blogs that Paul and Graham have written or anybody else. You can go and browse stock screens you might have set up. It's all there. It works really, really nicely. And we have a sort of a more limited view. So I'm on the Aussie site at the moment, but we have a more limited view. But this shows you Rio Tinto nicely, clearly, conservative large cap super stock with all the key fundamentals I was talking about. You've got the classifications and the ranks. You've even got the kind of the stock rank chart here that you can browse, as well as the key financials. So it all works really, really nicely on a phone. The important thing is that we don't have it in the App Store. You'd have to load it in the browser. So you go to stockopedia.com, log in, and you will get a prompt which will say add to home screen. I can't really show you this, but I'm just going to zoom out and I'll show you this. So turn screen share off. But if I show you my own phone, I hope you can see this. I've got it here as a little icon on my home screen. And the way that you do that is, I don't know if I can show you, but I would go, actually, it's easier on Android. But if I actually load Stockopedia through my phone, I'm not sure it's going to load, but at the bottom there's a little icon which is a share icon, and if you click that, you get this little thing. And if you scroll along, you get something that says "Add to home screen." If you add it to the home screen, you then get the chance to basically add it in. I'm not sure if that's very clear, but that's basically how it works. Anyway, yeah, you're right. Andrew's just asking a couple of questions about whether if you launch a fund. I mean, one of the problems with launching a fund is that, you can't actually benefit so much from a lot of the small caps that drive a return. And that's one of the things I'm quite passionate about with small cap investors, us as small investors, is that you can really benefit from the uplift in values of really the best of the small caps and buy them in a size which makes a difference to you personally, which it might not if you have a big fund with 100 million in it. It's very hard to buy £1 million worth of a small cap company. But if you want to buy like 10, 20, 30, 50,000, depending on your portfolio size, or even £1,000 or £2,000 worth, it's much, much easier. So liquidity is a real constraint in running a fund. That's also one of the reasons why we decided not to date. All right, guys, I think that's probably all the questions. So thank you so much for listening. It's been about an hour and 40. I've gone on probably longer than I would have liked, but lots of questions coming in, and I really wish you all the best of luck. Any questions you have, just ask. Either me or my team will pick up questions in the application. It's a real invitation to come in. Once again, do use that URL. And Sam will, send out any details for a replay and so forth. Thanks so much. Best of luck in the markets. Hope you'll consider it for your own investing, and hope to see you on the site. Safe investing, I like to say. Markets are a bit sort of wobbly and Brexity at the moment, but we're going to get through all this uncertainty. Better times ahead. The UK markets especially, and I know lots of people from the UK here, have been a bit depressed lately. Hopefully better times ahead. And, hopefully there'll be lots of, good opportunities to come. All the best. Wishing you all the best.